So a lot of people have been talking about, and obviously it's been all over the media, that there is a dramatic crisis in the U.S. banking system, whereby we've seen these regional banks, some of them quite large, literally disappear overnight. And while it appears as though all is well and there's some type of a patchwork Band-Aid solution, that there could be more to come. And the reason why people are thinking this way is because they're looking at how fast interest rates and how fast tightening was basically ratcheted into the U.S. economy by the Fed over a very short period of time. And when you start to look underneath the hood, what you're going to see is larger cracks starting to emerge. And the biggest pause for concern right now, I think, would be commercial U.S. real estate. And we're going to take a deep dive into that in a moment. But I think it's really important to recognize that that could have an impact on the Canadian economy. And as subscribers to this channel would be very concerned about potentially Toronto real estate. So we're here to take a look at that. My name is Ralph Fox, and I am the co-founder and broker of record of Fox Marin Associates, a boutique real estate brokerage located right here in downtown Toronto. And the purpose of this channel is to look at larger macro and geopolitical trends that could have a short-term effect or even mid-term effect on the Toronto real estate market. So going back to the subject of this video is, let's take a deeper dive into the commercial real estate sector in the United States. So basically, when COVID happened, basically everybody stayed home, and we had a lot of empty office towers in downtown urban city centers. And even after COVID, we've seen a very sluggish return to offices, and we've also seen the tech sector, which was a huge source of tenancies in a lot of these big buildings, get severely hit as well. And so we're looking at cities like San Francisco, where it's estimated you could have a vacancy rate of up to 35%. That is very significant. 35% of all office towers and skyscrapers in San Francisco will be empty by the end of this year. And that's just one city. So what's really important to understand when you're looking at the U.S. commercial lending structure is the majority of these loans, 80% or 80% plus, are being held by these smaller regional banks. So why is this a problem? Well, we already know that all of these smaller regional banks are under a liquidity crisis. They're very much left in a defensive lending position. And as these leases come up, we could expect to see some problems. It is estimated that there's over $1 trillion. I've heard as much as $1.5 trillion in loans coming up by the end of 2025. So this is really significant because these banks are under duress, as are the landlords. So we're in a situation now where we have these landlords who financed their properties 5 years ago at 1.5%, maybe 2%, and they're looking at paying significantly higher rates, while at the same time their revenues are significantly down, as are the values of their properties. And so banks are going to be in the position, these smaller regional banks, where they're going to be under a lot of duress, and all of these loans and valuations are going to be significantly underwater. They're not going to want to take over these office towers because, quite frankly, who's going to buy them? And so we're looking at a tsunami of these loans that are coming up, and it's going to be very difficult for anyone to want to take them on. And I think we could end up in a position where all of this is going to have to be backstopped by the U.S. Fed. And I've been reading, we're talking about over the course of the next couple of years, somewhere in the neighborhood of $2 to $3 trillion of liquidity in one form or another will have to be pumped into the U.S. banking system in order to stop the contagion. And so we're not just looking at landlords and banks that are going to be faced with issues here, but the other thing to really think about is you're going to have a lot of municipalities and cities who derive taxes from all of these big buildings going to be facing severe repercussions and downward pressure on their revenues. So cities are going to come under pressure. And the other thing to keep in mind is that, especially in the US, a lot of these buildings are either owned or partially financed as well by big pension funds or REITs. And there could be a trickle-down effect as well if they're put under significant duress financially because of this massive downturn in valuations and incomes, while there's a tremendous increase in cost to finance. So this is really significant as it unfolds. And so trying to understand what that could mean in the future here in Canada is a much larger question, especially for all the viewers or subscribers to this channel. And so I think it's really, really important to first recognize that we are not in Canada, we are not going to face the same type of commercial lending pressures because we just don't have as many large cities and we don't have nearly as many buildings as they do spread across the US. And we also have just the big five banks who are very well positioned to handle any fluctuations or downward pressure that we're seeing in the commercial market. So we're in a much different position than the US is, and I think we're far less vulnerable as we were in 2008 when there was a massive residential lending crisis. So I think that's not going to be the issue, but what I would expect to see is more liquidity being pumped into the U.S. economy, which by nature is inflationary. And at the same time, you're going to see a tremendous amount of pressure again on seeing interest rates or lending rates go down. So a situation where we have more liquidity in the system and pressure on interest rates, downward pressure on interest rates, could be very bullish on the future for Toronto real estate. So it's really difficult to predict what is going to happen. I don't think anybody really can, but we definitely have in the US anyways, a large tsunami coming down the pipelines of this commercial debt. And the banks aren't going to be most likely able to handle it. The Fed is going to have to step in. They're going to open up more liquidity. You're going to see downward pressure on interest rates. And I think that type of an environment is going to be very bullish for Toronto real estate, which is already facing a tremendous amount of demand and undersupply. So anyways, that's something to think about. And I hope you love the content here, and feel free to subscribe or write any comments below or questions. We'd welcome to hear from you.